evening, and thank you very much for giving me the chance to present to you all this evening. I'm going to run through what we do at Fidelity and in the Trust Fidelity Special Values. First of all, talking about the process and how we invest, then why importantly, why I think the UK market is a really interesting place to be investing right now. And then finally sort of end up with where we're seeing the opportunities in the UK market today and how the fund is positioned. So if we just talk about the bio of me and Jonathan, who are the co-fund managers on the fund, we've both got sort of pretty much 2 decades of investment experience, and I've been running the trust since 2012, with Jonathan coming on as my co-PM back in 2020. I think really importantly as well is the fact that we have a very large team assisting us. So it's not just me and Jonathan running the fund, it's having the backup of these 174 equity analysts globally, which I think is still, one of the biggest, if not the biggest, global buy-side research teams, with about 40 of those covering UK and European markets based in London. If you then have a look at how the fund is differentiated from other offerings in the UK, what we've done is actually pulled up here the open-ended peer group. So looking at Fidelity Special Situations, the open-ended version of the fund, compared to the number of peers here, because it's a wide peer group of about 240 funds. So you can see here that we are more value in the UK market and have a very significant mid and small cap bias. So those are the 2 sort of core characteristics of the fund, and that is particularly different compared to the bigger funds in the UK. So despite the fact the UK, I think, is a value market, as you can see here, the FTSE All Share just on the edge of value and blend in this Morningstar style box. Actually, the big funds in the UK tend to invest with a growth bias. So actually, you're not really getting differentiation in the UK fund if you go with the most popular funds. And we've got some analysis of that later on. So if we look at why value, and I think these charts are really interesting because over the long term, sort of all the academic literature that you can sort of check out if you want to do so, shows that actually there is a premium to owning value. So you outperform by owning value stocks over growth over the very long term. And it makes a lot of sense to me why that value premium has existed and continued to sort of exist over time. You can see that with the US market over longer periods than that, where the market data goes back beyond 92 that we're showing here on the left. And that's because value stocks are not that interesting in terms of they're not companies that are sort of necessarily going to be much bigger in 10 years time. They're not showing new technologies. They're not interesting stories, and they're more difficult to sell to sort of end investors. Whereas growth investments are new companies where things are changing, where things are exciting, and therefore there's much more clamour to invest. The issue is that when there's a clamour to invest and stocks are popular, generally they end up being overpriced. And if there's a disappointment in these stories, you tend to lose a lot of money. Whereas actually if things go great, that's what everyone already expected, so you don't make that much money. And that's why growth has historically underperformed. Now, if we go to the middle chart, what's interesting is through the global financial crisis and roughly the sort of 10 to 12 years afterwards, this value premium didn't occur in the UK market. So actually growth outperformed. And I think that was because we had a very unusual time of basically zero interest rates for an extended period. So there have been times where interest rates have been almost zero, but never for such a long period. And that means no cost of capital, no punishment of mistakes. So as long as you're growing revenue, it doesn't matter if you're not growing profits, and therefore growth outperformed, which was a big headwind to the strategy. Now, I think what's really encouraging as a value manager is we're back in the normal world. Since the trough in COVID in April 2020, in the UK market, value has started outperforming again. And again, I think that's gone pretty unnoticed. Most people are still heavily invested in growth stocks, very focused on the US, And actually, I think that is a mistake because earnings have started to be better in the UK market, keeping up with the US over the last 3 years. But yet valuations remain super low. So I think there's a huge opportunity today in value stocks and in the UK. If we then look at sort of the fund performance, and obviously Paul talked a little bit to the 10-year numbers right at the beginning in terms of the annuals, but I think what those years of very substantial outperformance that you can sort of see on an annual basis do when you compound them up actually produces very good returns over time. So you can see here over 10-year on special values at the top that, well, we haven't outperformed every year and we don't try and outperform every year. Over a 3 to 5 year view, what we're looking for is substantial outperformance of the UK market. And that is something we have delivered. So you can see here that over this period, the FTSE total return's been about 110%, where special values, including dividends, has produced a 240% return, and the NAV about a 212% return. So roughly double the returns of the market over time, even in a period where value has been out of favor. So you can see here that actually, despite value bouncing back in the last 3 years, has still underperformed the market over the 10-year numbers. So I think this process certainly has the ability to handsomely outperform and has done so over 10-year and over the shorter time period as well, as you can see on the bottom left. If we then look about why I think you should invest in UK equities, I think actually the UK has always been a good place to invest because it's a large capital market. There's nearly 2,000 companies listed in the UK, so it's the broadest market of any European market. It has a very robust regulatory framework and good corporate governance, which is very important. And it has a very wide range of companies and industries. And in fact, only 25% of the UK market is companies that actually have their revenues in the UK, whereas 75% of the revenues of the UK market are ex-UK. So actually you've got a good spread of global exposure by investing in the UK market as well. And I think because of some of the UK specific issues around Brexit and COVID, political uncertainty, the UK market has been really overlooked. And so actually this subset of international equities, as well as the domestic equities, are at very low valuations. And for me, that's what creates a really interesting opportunity. So you can see here that underperformance of the UK market over a sort of a 5-year period from the Brexit referendum. But again, I think what most people have not really noticed that performance has sort of bottomed over the last 3 years. So we haven't created new lows, and over this period, the UK has been roughly performing in line with global indices on a 3-year view, obviously having a much better 2022, giving up a bit of that performance to 23, but not creating new lows. So again, the UK market, it's quite a long time since we've really been structurally underperforming. But again, people haven't really noticed that. Now, this isn't because valuations in the UK have picked up, far from it. So you can actually sort of see UK valuations here versus the global MSCI index on a sector adjusted basis. So effectively taking out the fact that there's much more technology in the global market than there is in the UK, which generally trades at a higher multiple. What is the sort of like for like sector adjusted? And you can see actually the market has derated sort of through that sort of 2015 to 2019 range, and then further derated over the last year or so, as actually earnings have been quite good in the UK, but the market has underperformed. And what that shows on the right hand side is sort of where are price to earnings for the market as a whole versus other markets. They're at a very substantial discount. So as we just heard from the last speaker, sort of global markets more like sort of 19 times forward, UK markets more like 11. So that's a huge differential. So coming up for sort of half the price of the US markets. So that is very, very interesting for me as a value investor. Where is the value in the UK market? Actually, I'll pretty much say it's everywhere. And so it's not just versus other markets, but it's even versus the UK's own history. So over the last 16 years, the average price to earnings ratio for the UK market's been about 14 across both the FTSE 100, the 250 and the small cap, whereas today, all parts of the market are trading on between sort of 10 and 11 times earnings on average. So there's value, I think, right across the market cap spectrum today. Some of the areas I've been adding to more recently, indeed, have been some of the more small cap companies. And so you can see here the percentage of special values, which is in these sub £2 billion or more mid and small cap companies. And some of the new names, the likes of Direct Line that we bought last year, obviously in the headlines at the moment because it's received a takeover bid recently. Dowlais, also a new name, whereas I also added to the likes of Victrex, Coates and Keller in the last year. This shows the top 10 holdings in the fund. So this is a broadly diversified fund. Because we do invest down to these more mid and small caps, we have about 100 holdings in the fund, but the more mid and larger cap names tend to be in the top 10. And they're across a wide space of sectors, from support services to staples, also with a high financial weighting. That's an area where I particularly see value across both banks and life insurers. But it's a highly diversified holding, even within banks and insurance. So we have about 15 holdings across financials, because there is a lot of diversity available in the UK market in this area. Indeed, I wanted to talk a little bit about those financials holdings, because financials is a big part of the UK market, and indeed is about 25% of the fund. And so we are overweight the UK index, but not very heavily overweight. But the big funds in the UK, and today we're showing sort of the three largest funds here, the Lindsell Train, the Line Trust and Emerald Income, they actually have incredibly small overlap with special situations and special values. So even though they are UK funds, they tend to actually be buying sort of growth stocks. And I actually think, particularly in the UK, that is a mistake, because this is an attractive market for value. And so why would you want to buy growth in the UK? And the highest growth companies in the US, in the world are in the US, and those companies are generally growing faster than growth companies in the UK. So I think that if you want to get the diversification away from some of those big holdings, which are now at very high multiples in the US, I think sort of being in a value fund is a great place to be. And the areas we're really excited about in the UK, are those value sectors, particularly in the financials area. This then looks at sort of the fund characteristics compared to that UK market. And I think what's really interesting for me is that while the UK market is cheap on about 11 times earnings, the fund is considerably cheaper, so on about 9 times earnings. And we're not getting there by having lower quality than the market. Actually, our returns on capital employed are roughly in line with the market and are actually forecast to grow faster. And we're taking lower risk than the UK market by having less debt to EBITDA. So I think actually you can get a really good quality portfolio without taking on too much risk, but a very low valuation by investing in the fund. One thing that we have seen in the UK market that's definitely worth talking about, as I mentioned earlier, is the fact that these low valuations are really encouraging M&A in the UK. And this has been a source of strong performance for the fund over the last 2 years, with all of these companies having received takeover bids in the fund. Not all of these have been accepted. Indeed, we have pushed back on some that we thought were very much undervalued, like the PhotoMe bid. Stock subsequently more than doubled since then, and we subsequently sold out a much higher valuation. A number of others, indeed most of these have gone through, and most of them I would say have been at reasonable valuations, because they've been offering sort of 40 to, in some cases, up to 70 or 90% premiums to the undisturbed share price. So it's very clear that global corporates and private equity are recognizing the value in the UK, even if the markets as a whole are not doing so today. So to sum up, I want to talk just conclude that I think it's a very attractive time to be investing in the UK market. But the reason it's exciting is that the value that's on offer. So yes, there are a lot of macro and geopolitical headwinds globally, but those are global headwinds. whereas the big valuation issue with markets globally doesn't exist in the UK. So you've really got good protection from valuations here, even if there is a downturn in the economy. And you've got a lot of stocks to choose from in an area that many people aren't looking. So our ability to add alpha in this unpopular space where lots of investors aren't looking, I think is very high. And that's why I think one of the reasons why we've been able to substantially outperform this market over time, and very much would hope to be able to continue to do so going forward. Thank you very much.